Hi, it's Dave Bolduc with the Bella Group. Welcome to my weekly real estate market update. It's May 14th. Happy birthday, brother. Refinances are down 71%. Oh my God, what are we going to do? Well, we're not going to do anything. But let me touch base on a couple of things really quick. So first, if you get some value out of this information, please click the like button, subscribe. Comments, please, I would really appreciate them. It helps with the YouTube algorithm, gets more information out there to more people. And I'm not trying to make money here. I'm just, passing along information so that everybody knows what's going on and all the disinformation that's flying around out there. There were 824 new listings over the last couple days. It's about where we've been. We have 4,534 active homes on the market. It's a little bit down, like 20 houses down from last week. So we're at a little bit of an equilibrium buy and sell. 54,000 homes were sold in Connecticut last year. 27,000 would be 6 months worth of inventory. We like to have 6 months worth of inventory on the shelf. We are very below. We're well below that at 4,500. So we're still in extremely low supply, and there's still very, very strong demand. Let's get into this interest rate stuff and how it's impacting the market. And the first thing is I just want to put a little bit of perspective around this. Over the last 50 years, the peak interest rate was back in October of 1981. It was 18.44%. So it's about 3.5 times higher than where we are right now at 5.3. So just to give you a little bit of a perspective. 71% drop in refis. Like I said before, the world is going to end. No, it has nothing to do with it. So first off, refis are somebody owns a house and they're going to refinance it to try to get a better payment or maybe get a little bit of cash out. Has nothing to do with buying and selling houses. So that's a red herring. Has nothing to do with buying and selling of houses. The reason it's down 71%, this chart, the gray area is the activity in refis. So the higher it is, the more refis, the lower, the less. And then the orange bar orange line is interest rates. So as you can see, as interest rates go down, the number of refis go up. That makes perfect sense. And what we're seeing is that interest rates have spiked over the last few months. And amazingly, refinances have dropped off. There's nothing going on there. That is perfectly normal. There's no reason for someone who has a 3% interest rate to refinance into a 5% interest rate. It doesn't make sense. Now, if you had a 4% interest rate and you were refinancing into a 2.5%, that may make sense. But the 71% drop year over year, yeah, because interest rates a year ago were much lower. So obviously there's going to be fewer refinances. There's really nothing there. Now let's scale it back out, and you can see the same thing. Same chart, just on a longer time scale. They only started collecting the refi activity back in the 90s. So you can see every time interest rates drop off a little bit, refinances go up. It makes sense. And then when interest rates come back up, refinances drop off. There's nothing going on here. Purchase index is this next chart. And so this is the gray area. The higher the gray area, the more activity on purchases. So this is mortgage applications to purchase a home rather than to refinance a home. And you can see right in the middle of the chart that big bubble. That big bubble is the real estate bubble in 2005, 6, 7, 8, right? You can see interest rates were relatively flat, crazy activity, and then everything collapsed. Whereas now you can see that we did have a little bit of a peak, the last couple of years, but that was when interest rates were through the floor. And lower interest rates allow more people to spend more money on a house because the interest rate portion of your payment is smaller when your interest rate is lower. That's all that is. There's nothing else going on here. And you can see that the purchase index is dropped off as interest rates have gone up. What does that mean? That means that some people who might have been able to purchase a house 2 years ago, or people in those same financial situations, they may not be able to buy a house right now because the interest rate's gone up, the interest payment portion of your total payment has gone up, so you're not able to buy a house or as much of a house. So this is very normal activity. The activity we saw in 2006, 7, 8, that's not normal. The activity we're seeing right now makes a lot of sense. It's very normal. Nothing going on here. Final thing, I've shown this slide before. The last 6 times that interest rates have gone up by 1% or more, we've seen housing prices continue to go up at an average of 8%. What we've also seen is that the sales have dropped off by a little bit, by about an average of 5%. which makes sense. If prices are going up and interest rates are going up, then it's going to be more difficult to purchase a home, or more expensive to purchase a home. So some people will be priced out and they won't purchase a home. Right now, the demand that we're seeing is driven by the supply being so extremely low and demand for people getting out of high population density areas into lower population density areas. The only thing that I'm seeing right now that is a potential black swan, red flag type of thing is that a lot of institutional buyers, REITs, real estate investment trusts and things like that, are buying more and more single family homes and then renting them out. I don't know how many they have. I know that in the United States, the numbers that have been thrown around is we're as much as 5.8 million homes short of where we should be from an inventory perspective. So if REITs owned 10 million homes, which they probably don't because there's only 68 million in the United States in total, but if REITs owned 10 million and decided to sell them all at the same time as the stock market decided to start going back up, maybe that could cause a problem. But if they own, a million and a half when we're 5 million short, it's not going to cause the market to crash. So I want to gather more information on that and understand it before I give any kind of opinion. But I'm just throwing out some numbers and saying that this is one of those things that for me might be an issue. But the stuff that I'm seeing on refinances going down and new mortgage applications going down, of course they're going to go down. Interest rates are going up. It's not something new. It's not something that hasn't happened before. And we're not seeing it at a level, the response at a level that's outside of what we've seen in the past. So right now, I just want to close this video by saying, if you're looking for a house, if you're interested in a house, there are great deals out there still. You got to be quick. You got to be ready to move. If you're a seller and you're looking to sell, now is the time to sell. There is a ton of demand and very little supply. Feel free to give me a call, shoot me a text. My contact information is all over these videos. Look forward to talking to you. Until next week, have a great day.